Hi, everybody. This is Kevin with Leading Edge Financial Planning. And today we have Andy Christopher with us. And Andy, welcome. We're going to do a video on Delta, all the different retirement accounts. There's so many, Andy. What are your
Yes.
thoughts?
Yes. Lots of options for our Delta pilot friends to save, lots of things to think about. But pretty exciting stuff. If you're in that season of life where you're fortunate enough to be able to save a lot, there's a lot to think about here.
Yeah, so we can say with Delta that they might have the most plans right now. But anyway,
Yes,
never want to say that.
that's
So
right.
let's jump in, Andy. So really, what inspired this video for us to make this video is the non-qualified plan that's just come out by Delta, and we
Yep.
think we wanted to chat a little bit about where it fits.
So I think that's kind of big news for Delta, and we can talk through those mechanics. We obviously work with a lot of Southwest pilots, right? They have already had these features in, and so we've seen a lot of our clients who work for that airline how they do it, and Delta I think is probably the only other one that I can think of, a major that has this non-qualified deferred comp feature, and so we can
Yeah.
they're different, but similar in terms of um, how we think about using it. But yeah, let's jump in. Maybe the first thing we want to talk about is just outside of the deferred comp plan, but kind of big news. If you're nerdy like us, Kevin, and think
Yeah.
that IRS
Thank
limits
you.
are big news. Yeah, so in a nutshell, big picture, you can get up to 24,500. That's pre-tax or Roth into the 401k. So that's up 1,000, 23,500 for this year in 2025. So that's good news. What's called 415C is now 72,000. So think you plus your employer, airline, that non-elective contribution, all of those things going in, you're limited to the 72,000. That doesn't include the catch up, so something important to keep in mind.
That's right.
And this does have spill implications. We'll talk about that in a little bit. The 401A 17 is now 360,000. So this is the maximum amount that or what is based. This number is what's based on for the max amount that can go into the 401k from the employer or from the airline.
Yeah.
So
That's income, Andy.
income, that's right, income, not a contribution limit. This is an income-based number.
That's right.
Um, so what does that translate to? If you have an 18% non-elective contribution, that's most of our airline folks, the most they can put in is 64,800. That, of course, would imply that you put in zero into that. Always important to make that distinction because if you do nothing, you will not get the full amount into your 401k based on this 401a 17 limit.
Yeah, Andy, let me just pound the table there for a second, because a number of years ago, if pilots didn't put anything in, many pilots still maximized. But now,
Yeah,
if you don't put anything in, you're not going to be maximizing the amount you can put into your plan.
that's right. That's exactly right. And now catch up 50 plus 8,000. If you're 60 to 63, 11,250. That one actually this number didn't change. This number went up just a little bit, $500.
So
So good.
$80,000, Andy, can now be saved in the 401k between the company, between Delta, and between you. That's
That's
an
right.
awesome amount of money.
Yes, yes. And then you start talking about cash balance plan, and then you start talking about deferred comp.
Yep,
Outside of
yep.
the 401k world a little bit, but IRA limits, that catch up amount is now, sorry, not catch up amount. The total amount is 7,500. Age 50 plus, you can catch up to 1,100.
So
So
we're
that's
seeing here the 1,100, Andy. We're finally seeing that they said that you could raise it by the amount of inflation or thereabout, and it's $100 now is the number. Is instead of waiting like 4 years and jumping up 500,
that's
it's
right.
jumped up 100, which is a good thing.
Yep, yep. So big things to think about. Take a look. Rounding the corner in 2026. A lot of our higher earning pilots haven't been making contributions just because they've maxed those numbers out. Take a look at what your contribution is. Make sure you're going to hit those numbers. If you're making monthly contributions for like a backdoor Roth, make sure you take a look at that because those numbers have definitely changed for how you're looking at it. Things we're doing for our clients now as we're rounding the corner into the new year. All right.
Yeah, thank you, Andy. Before we get to the next topic, let me just say that, really the 401k, the contributions into the 401k really control a lot. It also controls the market-based cash balance plan, how much money is going to spill into there. So I would just encourage Delta pilots in the beginning of this year of 2026 to go ahead and think about how much they want to get into their market-based cash balance plan.
Yeah, that's exactly right. Especially on the 415C limit, that 17,000. That's the one that you, the pilot, have a lot of influence over for how much spills in that cash balance plan. The 401A 17 is kind of set in stone. Obviously, those two in conjunction are what matters from how much money you're going to get to go into that cash balance plan. Non-qualified deferred compensation
So the
plan,
NQDC.
NQDC. That's exactly right.
Okay. So
Exactly
tell
right.
us a little bit about these types of plans. How did they come about?
Yeah, I think, what's in a name, right? So first thing is, well, it's non-qualified. That tells you something right there. And it's deferred compensation. That also tells you something just right there in the name. So what does it mean to non-qualified? Well, 401k, right, is a qualified plan. It has ERISA protections, but there are lots of rules associated with that in terms of the structure, payout, protection,
Right.
most importantly. And when we get into the non-qualified world, this is really designed for high earners, executives in companies. Hey, how can you defer more income? You're likely in the highest marginal tax bracket. You're making a good bit of income, and you want to do what we were talking about earlier, tax arbitrage. I'd like to not
Mhm.
pay that tax now. Down the road, when I'm potentially in a lower tax bracket, I'd like to then receive that. The way we think about it, if you're in retirement, right? I want to I want to start taking this money maybe in the 22% tax bracket or 24, what have you. Everyone's situation is of course different, but how can I take advantage of these differentials and tax brackets that I may find myself in?
And can you talk a little bit about how you sort of own the money, but Delta still sort of owns it?
Yeah, the buzzword here is rabbi trust or buzz
Hmm.
phrase, right? And so
Hmm.
that money goes into a rabbi trust, meaning Delta, if they decide they want to buy 10 new A350s, can't go in and use that money to go buy 10 new A350s. But if Delta were to go bankrupt or have any sort of company issues, it would be accessible to creditors, right? So they would be able to then go in and use that. So the risk of you as a participant in a non-qualified deferred comp plan is that if something happens in the company, you may not get that money. So all that income that you deferred, you actually never get to take advantage of. So that's definitely a risk to keep in mind, and probably the number one thing talked about, especially in the
Hmm.
context of the airline industry, the volatility that most folks, if you're listening, are aware of when it comes to, should I participate in this type of a plan?
So Andy, let me just pile on there. So they do subdivide the money. The money is put into a special rabbi trust. It's
Yep,
going to show up on the assets, the balance sheet of the airline, and they have a contractual agreement with you. As long as they're good to go, they're going to allow you to take that money out, right? But if something happens to Delta, where it's worst case scenario, then all of a sudden you get in line. You are a creditor at that point, but you get in line with all other creditors.
that's
Did I
right.
say that right?
Yep. Yeah. And you still have market risk as well, right? You choose investment allocation, the value of that investment can go down. That's different than, say, like a market-based cash balance plan where think about you've
Right.
got a floor, right? Because that's a pension plan, qualified type plan, the market-based cash balance plan. So there's just different nuances there that again are important to think about before jumping into the deferred comp land.
Okay. So, this is kind of crazy. I have the 401k, I have the market-based cash balance plan. Why would I use something like a non-qualified deferred comp when that's still a little bit at risk that if Delta has a problem, I have a problem.
Yeah, and maybe there's obviously disclaimers abound
Yeah.
here about
Yeah. Yeah.
this is certainly not financial advice. Everyone's situation is unique, and consult your tax and financial planner and advisor. Um, how do we think about it, right? If you're that high earner captain, you're 55, 60, getting close to retirement. And the way I would think about it is I've pulled all my levers, right? Like I'm just
Hmm.
crazy saving.
Hmm.
Um, we've got what we need to support our lifestyle. Maybe we've got
Right.
two spouses. One of them is also a high earner.
Yep.
And so I've pulled all these what I'll call qualified levers, and I'm like, what else
Hmm.
is there? And I'm in this high tax bracket. Uh, that's a time where I would think about like now I can turn on this other lever, and it's all it is, it's a
Mhm.
tool for tax and retirement income planning, I can pull that lever and use that to save and defer more for retirement. But Kevin, how would you think about it?
Well, no, I mean, I think that's absolutely what it's for, is to defer taxes into the future. Now,
Yeah,
it is not tax free; it's deferral, which means that if you are in a 35% tax bracket now and you defer it 5 years and you're still in a 35% bracket, you've deferred tax a little bit, but the ultimate pain is still there, Andy.
yeah,
And you also have to worry about when you take the money out is, if you're all in stocks, and the stock market crashes when the money's going to come out, that's a problem as well. So I do think there's multiple problems here. The tax deferral is the benefit, but the other choices are to do like a brokerage account, Andy,
yeah,
um, to do a 529, take the money out, do a 529, pay tax now for your children, or just defer the tax. So if you know for sure that you're going to be at a lower tax bracket later, then this might be something to consider. Again, who knows what the tax brackets are going to be in 5 or 10
that's right.
years?
Yeah, and so I think we're starting to sprinkle at some of the nuances of this Delta plan in particular. It's like, well, what are you going to do when you set this up, right? And so you have options here in terms of how to defer and how to get payouts. So one is you can do the retirement termination account, which means that when I retire, I'm going to get this payout starting. I believe they said the valuation is the first day of the second quarter after you retire, right? It's like very sort of
Right.
nebulous. You got to read that a few times to actually figure it out.
Yeah.
So you'll get that. You can do a lump sum up to 10 years. That's when you retire. So right, 65 out to 10 years. Then you have, which is pretty standard, I think, for a deferred comp. The
Mhm.
nuance here is it's called this in-service account. And you can
Mhm.
set up to 5 in-service accounts and stipulate those distributions that can actually occur prior to you terminating with the company or retiring for the company. So theoretically, you could have 6 different accounts all going at one time, and a lot to manage there. Each of those can have their own payouts. Those in-service accounts, you can pay out lump sum up to 5 years. So a little bit of a difference there. But this could be a bear to manage, right? We were like putting spreadsheets together. If you've got 6 of these things going, 5 in service, 1 termination account, there are some very important wickets and dates to hit to decide, am I going to take the money from this in-service account, or am I going to then subsequently further defer the distribution out into a future date? The one last detail I'll say is if you don't take money out of the in-service account when you terminate, those in-service accounts will then roll up into the distribution plan of the retirement termination
Retirement.
account.
Yeah.
So there's a lot of moving parts and pieces, which again is why it's so important to kind of talk to an advisor, talk to somebody to kind of map all these things out.
Yeah, don't try this at home, Andy. So what good looks like here is, and you're in the 37% bracket and you're in a state that has an income tax. I think California will still tax it non-qualified, I think. But
Yeah,
anyway, we can check on that. But you're in 37%. Let's say you're at another 8%. So you're in 45% pain right now. And you know that you can be in the 12% bracket in the future. So that's the tax
yep,
arbitrage that we think about.
yeah,
Most of the time, Andy, we've not really seen it work out that way. We've seen people that have gone from a 37, 35% bracket. We've seen them retire, and really they can get into the 22 or 24% bracket. So
yep,
there still might be some goodness there.
yeah,
But the in-service one, I still am not sure I understand unless you're going to quit flying. And then if you quit flying, then you then you leave the organization and you still get it paid out. So
yeah,
argue why you might do an in-service.
yeah. Think about this way. Um, totally right. The taxes are a problem. Let's say you are happen to be 45-year-old captain and you
Right.
want to do a non-qualified deferred comp. You and now back to our discussion of why is this not qualified? Why, it's the rabbi trust, it's the creditor access. So if you put it in a retirement account with a 10-year distribution, you have a theoretical 30-year window that you are dependent upon Delta to be solvent, if you will.
Yeah. Yep.
Okay. So you could then elect to say, oh, I still want to participate. I'm young. I think it's important. I want to I'll pull all the levers I can. Let's pull this
Right.
deferred comp plan. I'm going to put it in
Right.
an in-service account, right? And now you still deferred out a number of years, say 3 years. But now you get to make a decision 12 months prior to that payout about the health of the company, your personal financial situation, all of these things, and then say at that point, okay, I like the trajectory I'm on, push it again. I'm going to defer, or I'm not flying as much, or my spouse retired, we're doing great. I'm going to take that money now. Now I'm in the 24% tax bracket, something to that effect, and I'm going to start taking that money. So there's some nuance there, right? And again, it's back to like there's a lot of things to think about because if you decide to change that in-service account distribution payout method, meaning you want to go from lump sum to 5 years, 5 years to lump sum, and the payout date, you have to do it 12 months prior to the payout date, the established payout date. So you got to know when that is to make that change.
And then
And
you have to
then
push it out 5 years,
that's
right?
right. That's right. And then you've got
Maybe
to push it
five.
5 years. That's right.
Yeah. Yeah.
So
Okay.
I talked out of both sides of my mouth a little bit. The good in-service account is you have a little bit more flexibility on a lot of different factors at play about the
Yeah.
distribution. The challenge now is you've just added a lot of complexity into your life uh, to manage this and remember it
Not
and
to
think about.
mention that if you pull the money out in service, you will pay probably the same or even a higher tax bracket because your pay is going to go
Yeah,
up over time.
that's right.
So yeah, the in-service again, there might be a reason for it, but tax-wise, it's probably not good, Andy.
Yeah, yeah, it depends on kind of where you're at again. Everyone's situation is gonna be a little bit different. The other
Yep,
thing I'll throw out there that I like about the plan is you can change your investment options um, essentially at will. You can set it up the very similar to a 401k. That's different than the Southwest pilots that we work with, where once you
absolutely.
set it once, you're kind of stuck. We've seen a lot of them, and 10 years ago they put it all in the S&P 500, and now they can't change it for that amount they contributed in the past. And so I like that as a Delta pilot, you can change your investment options and rebalance to a desired allocation.
Yep, absolutely, Andy. We were playing around a little bit with the calculator that you built, Andy, and we saw that you could put in multiple hundreds of thousands of dollars as a captain, but we thought we would just share. So this is not the multiple hundreds of thousands, but it
That's right.
is 45 extra $1,000 or 10%, Andy. So go ahead, talk a little bit about what we see
Yeah.
here.
Yeah, you can save a lot, and by a lot, you can put up to 75% of your income, pilot income, into the deferred comp, or 100% of the profit sharing
Hmm.
into that plan. There's some nuance there in terms of ordering of withdrawals and how that will play with your 401k to bear in mind. But yeah, let's just say you're a 777 captain, 12 plus years, you're doing 80 hours a month. You could put, at a 10% deferred comp rate, you could put about 45,000 into this non-qualified deferred comp plan, whether that be a retirement termination account or an in-service account. You're still going to, want to, I should say, I'll say want to, this assumes you're in the 50 plus catch up here, fill up the pilot contribution plus, of course, the 18%. That gets you the 80,000 that you alluded to.
Hmm.
And you're still going to get market-based cash balance plan, again, under these assumptions here. So like all of these factors combined is a pretty impressive savings rate. Again, this is like the levers that I'm pulling
Yep.
as I go down the savings kind of paradigm, if you will. But man, you can really defer a lot of income. You can, of course, get a lot of income into Roth, right? We know that catch up is going to be Roth starting next year. Just a lot
Yeah.
of really good retirement savings here.
Yeah, I mean that's about $160,000 between all of the plans, and yeah, I mean that's a lot of money. I don't care who you are. That's a tremendous amount of money. So
Yes.
so Andy, if we come down to like who might this be right or wrong for? We can never say right. Who's it right for?
Yeah.
But is there anyone that you're thinking about that it might be better for?
Yeah. Again, I think it's that high earner. You're close to retirement. let's say you're the 60-year-old captain, um, and we can design a payout structure post-retirement that is from this deferred comp. It's a really nice off-ramp, the way we've seen it with our Southwest friends,
Yeah.
from age 65 mandatory retirement into, a 5-year payout. Of course, you go out to 10 on Delta. Maybe it's a Social Security income bridge, if you will. So,
Hmm.
so a lot of like very cool ways to think about how to use this, um, if you're approaching retirement. But yeah, I do think it's kind of like that older, I'd say not older, closer to retirement individual, who's again looking for ways to save, looking for ways to minimize taxes.
Yeah. So what other concerns might someone have with these plans that we've not talked about? You mentioned about the investments.
Yeah,
You mentioned about the timing of when the money comes out. Also, what if taxes change in the future and they go
yeah,
up? That's
yeah.
always a possibility. What about sequence of return risk? It sounds like that's not that big of a deal because you can change the investments. Is that
Yeah,
right?
Yeah, I think so. I mean, just for everyone, sequence of return risk is just market returns early in retirement, and specifically or poor market returns early in retirement can have a much more detrimental effect on someone's just retirement and ability to spend in retirement for their 30 plus years they'll be there. So maybe this is a way to mitigate that. In other words, you've deferred this income into a deferred compensation plan. You would then, of course, allocate it into a much more conservative type portfolio. You then wouldn't have to touch your 401k, your Roth,
Right.
your retirement brokerage account for this period, or you would take less from it because you have this deferred comp that's paying out
Right.
annually to you. And so to me, there is a little bit of and it might be some behavioral kind of mental accounting going on here, but I
Sure.
do think there is some sequence of return because again, it's still exposed to market risk, but there is a sequence of return type risk mitigation. You've
Right.
primarily mitigated it because you've just done a better job of saving, uh,
Yeah.
because that's all this really is saving for retirement.
Yeah. So you could
But
have the
yeah,
money come out 5 years from 66 to age 70. But there is one more gotcha here, Andy, that most people don't know about, and it's IRMAA.
mm,
And 65 is also an age of Medicare. So can
yeah.
you quickly just run through that as well?
Yeah, and I don't know the numbers off the top of my head, but just know that if your AGI, hits certain thresholds, and
Yeah.
it's an in or out once you're 65 and older, that will change your Medicare premiums. It'll increase your Medicare premiums, and that's a 2-year look back actually. So that's another nuance that's important to keep in mind. Uh, the whole idea here is if you start doing Roth conversions, if you start doing deferred comp payouts, you may push your taxable income or adjusted gross income to a point where those Medicare premiums go up from kind of that base amount. So you want to just the bottom line here is do tax projections, right? When you think about this, when you start looking at what this might do.
So Andy, I mean, I think that's the key. If you want to do this, find out more about it. We're not saying this is enough. Find out a lot more about this. Do tax projections for the years that you might take the money out of the non-qualified plans. You
Yep,
might have higher income than you think. You might not be doing much. Probably Delta is going to be fine for the next 50 years and not have any problems, but there's always a chance. So
sure.
anyway, Andy, thanks so much. Appreciate
Yeah.
all your thoughts. Any parting shots?
No, no, I think if anyone's certainly interested in learning more, you want to run a projection, see what this looks like, by all means, please reach out to us. We're happy to kind of provide that advice. I do think Delta, their Engage podcast is a great resource as well. I've listened to
Sure is.
that. It's chock full of great information. So a lot of information out there to make an informed decision. And then open enrollment window, you're in it now.
Yep.
Um, and I'd just say like think long and hard about what it is you're trying to accomplish.
Leading Edge Financial Planning LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as